Consensus is, as you just heard Michael say, that Ben Bernanke is going to leave rates on hold and allow the QE2 program to go through the end of June. Our next guest says it is hurting the U.S. economy, and he points to Japan as an example of why it won't work here. With us now is Richard Koo. He is chief economist at the Nomura Research Institute. He is joining us from Tokyo. Richard, thanks so much for being with us this morning. When you were at the New York Fed, President Reagan was in office. 10-year yields were at 14%. You said the market was sending a clear message of no more government debt, please. Now the 10 years at 3.3%. Is there just as clear a message now?
I think that what the market is telling us is that this is no ordinary recession. This is a very special type of recession that happens only after bursting of a nationwide asset price bubble. And we went through that in Japan 15 years earlier. Now the U.S. and Europe are going through this bubble, this recession, which I call that balance sheet recession because there's no other name for it. And in this recession, the key point is that the private sector is actually minimizing debt, not maximizing profits. Because asset prices collapsed, liabilities remain, and the balance sheets of these private sector sorts are underwater. And in this type of situation, even if Federal Reserve lower interest rates, very little happens because people with balance sheets underwater are not going to borrow money at any interest rates, and the bankers won't be lending them that much money either, especially if bankers themselves have balance sheet problems.
So, Richard, I hear what you're saying.
In this type of recession, I'm afraid, monetary policy is largely irrelevant.
It's irrelevant in the sense that, to your point, I mean, consumers and businesses are basically just trying to feel healthier after this big bubble. So with that in mind, and if the Fed's monetary policy is completely irrelevant, what should the Fed be doing now?
I think Federal Reserve understands that the economy is not all that robust. And I think Mr. Bernanke in particular understands that. I mean, I testified with him in July, Humphrey Hawkins' testimony, and he was very clear about that this is no time to cut fiscal stimulus. There are a lot of Republicans who wanted him to say that this is time to cut fiscal stimulus, but he said, no, this is no time to cut. And in that sense, he understands that we are still in what I call balance sheet recession.
Do you think he thinks that he made a mistake?
What the Fed can do really is very limited. Sorry?
I was going to say, do you think that the Fed chair, Ben Bernanke, thinks that he made a mistake given the economic conditions now?
Well, Fed had to do something, and quantitative easing is the only thing they could do. But if you look at what happened to money supply in the United States, for example, it did not grow as much as suggested by the liquidity in the system. And credit available to the private sector actually fell during this period. And so I'm afraid quantitative easing didn't do all that much. It didn't do much harm, perhaps except through the commodity prices. But other than that, I don't think it did very much. I mean, we have zero interest rates for the last 2 years, and house prices are still falling. We have unemployment rate at 8.8%. You know, this is no usual economy.
Richard, we're going to take
zero interest rates for 2 years. We should be seeing 3 or 4 bubbles by now.
We are back. We have more with Richard Koo, the Nomura Research Institute chief economist. He is joining us from Tokyo. Richard, thanks for staying with us. Before the break, you said that QE2 has really done nothing for the U.S. economy. Out of curiosity, I want to talk about the FDIC, the new fee on bank assets. Is this more or less canceling out QE2? If so, what are the implications for the economy?
Well, I think these measures are made to have a robust banking system. And, of course, by itself, it's not a bad thing. But at the moment, I think people are worried that more fees on the banks means higher cost of borrowing money. But at the moment, I think the greater problem is not whether the funds are available, but whether the borrowers are available. I mean, we see deleveraging going on at all places, and that's why interest rates are so low in the United States at the moment. And so what we need to encourage is more private sector to come in and borrow money, and that will only happen after their balance sheets are fully repaired.
So, Richard, at this juncture, I mean, what is the chance that the U.S. economy actually gets worse? In other words, lower tax revenues are able to be collected, GDP growth slows. I mean, what is the worst case scenario we could see from here?
Well, in this type of recession where private sector is minimizing debt, you need government to be borrowing and spending money. But we see that Washington moving increasingly toward fiscal consolidation, I think at the worst moment in time, because right now we still need government borrowing and spending money to keep the GDP from collapsing. I mean, the fact that private sector is minimizing debt with zero interest rates, deleveraging at zero interest rates, means that private sector is still sick. And we need government there to help private sector recover. Once the private sector recovers and comes in to borrow money, then that's the time to cut the budget deficit.
Richard,
but not now.
You've pointed out in past in your research that in 1997 and in 2001, there were what you called premature reforms, and they ended up hurting the economy, right?
Right.
So you see that happening
when
again.
When the private sector is deleveraging and government delevers too, the whole thing collapses. That's what happened during the Great Depression. And we made the same mistake in Japan in 1997 and 2001. And I see Europeans making the same mistake right now. And if the U.S. Congress moves towards fiscal consolidation, U.S. will be making the mistake next year. And I just don't want to see that happen.
But right now you do see the U.S. on track to repeat Japan, the same situation where it endured years of stagflation, stagnation.
Because rating agencies are trying to downgrade U.S. That's what happened to us as well. And that kind of scares the politicians from putting the necessary medicine, which is the fiscal stimulus to keep the GDP going, allow the private sector to have the income to pay down debt. But when rating agencies look at only the budget deficit, not what's happening to the private sector, and start cutting the ratings, then the politicians get cold feet. They don't want to put in the fiscal stimulus, and the situation can get worse and worse.
So we know that you think Standard & Poor's warning was misplaced. Richard, thanks so much for joining us. Richard Koo joining us there from Tokyo. He is the chief economist at the Research Institute at Nomura.